By now you're in a position where you can understand the candlesticks, you can understand trend lines, and the support and resistance. Now, other than that, there is something called candlestick pattern and chart pattern. These are some commonly occurring pattern that has been coming down from so many years, and the people have taken a note of it. And now it is in term of a study material or content that price action traders normally use. So let's get down to understanding what exactly are these patterns and how do we use that in the live market. Now, what you can see on the screen is my Discord server with around 2000 plus members. So you can join the server. There's a lot of study materials here that you can use. Plus, there are a lot of traders that you can ask your questions with. We're going to be very active on Discord. I'll be doing a lot of free sessions discussing about the concept, discussing about the course, and I'll also be adding a lot of new content on the Discord that will help you become a good trader for Ledger. So if you're not still on the server, please join. It's more like a community, and yeah, you can go ahead and enjoy the process. Now let's move on to the concept. The first chart pattern, some of the most commonly used trading pattern, chart pattern, which is head and shoulder. Now what is a head and shoulder pattern? If you look at the chart carefully here, you will see that there is a bullish trend following up here. So this bullish trend gets converted into a bearish trend. It makes a left shoulder in the market. So that is going to act as your left shoulder in the market. Now, other than that, you have another bullish trend which goes higher than the previous high, and it brings back or falls back and forms another swing low in the market. Now, the second high is higher than the previous high. That is a point to consider. And then the third high that market makes is equal to the first high. So the first high and the third high are almost similar and they look equal. Only the second high gives a much higher look on that. So this becomes your head, that becomes your left shoulder, that becomes your right shoulder in the market. Now look at the cursor very carefully. I can draw a level over here. If I draw a level over here, that will become the neckline in the market. On the neckline, if I have a neckline break, I'm sure you can see this line here, the dotted lines. So if I have a neckline break over here, then that simply means that the market is going to be very bearish from there. So head and shoulder is a bearish pattern, and on the neckline break you can sell positions because the trend is going to be more bearish and the fall is going to be strong. So head and shoulder is commonly used as a bearish pattern. Let's move on to the next, which is double top pattern. Now double top is one of my favorite patterns because you get that easily and it works incredibly as well. In this pattern, it is similar to head and shoulder. The head is missing but the shoulders are active. So you have this one high, you have a low, you have another high, you have a low. If you can see the circle that is marked over here, that is going to be your first high, that is going to be your second high, and the market has started falling down, and this becomes your neckline in the market. Now on the neckline, if there is a neckline break, the market is going to give you a tremendous fall. So again, double top is a negative or a bearish pattern. So after the neckline break, you can sell your positions. Next, which is the double bottom pattern. Again, one of my favorite patterns. It is just similar to the double top. Basically, in double top, you look for the neckline break for a bearish position. In this, you look for a neckline break for a bullish position, my bad. So how do you look at this? You have a fall and you have an uptrend, you have another fall, you have an uptrend. In a way, it is forming a W kind of pattern, and the neckline is going to be this area where there's one low, there's a second low. So if you draw a line over there, as soon as there's a breakout, just like this candle has given a breakout, you can add your positions because from there all the buyers are going to be active and a lot of bullish sentiments will be built and the price can go higher from there. So that is double bottom pattern. Now we have a rounding bottom. Rounding bottom is something that is not commonly found in the Indian markets, and I wouldn't suggest you to look at this pattern because most of the time I'm not completely satisfied with the way these markets behave for this pattern. So we will ignore with that. But there's something called cup and handle pattern. That is something I use a lot. It is similar to the rounding bottom, but it is more prominent, more trustable than that. Now, how does this work? It's going to form a round shape over here. It is like a semi-oval kind of a shape or semi-circle kind of a shape. And then the market is going to give you a flag pattern here. This is called a flag pattern, which we will be covering in the later segment. So it is a combination of this flag pattern, or let's say this combination of highs and lows with a round pattern. Now, why is the name cup and handle? Because you can clearly see that it looks like a cup with a handle on it. And then when there is a breakout on the top, there is a bullish move from there. So this is moreover a bullish pattern. Now let's move on to the raising wedge and falling wedge. Now there are two types of wedge in the market. One is a raising, one is a falling wedge. In this segment, it is a falling wedge where the market is in a downtrend, and the closer the price goes towards the edge of the price, the edge of that funnel, we can expect a breakout. Similarly, in this example, if you look, there's one high, there's another high, and there's one more high here, and there's one more high here. As soon as there is a breakout over here, you can see that right over here there's a retracement touch, and the market has given us a good bullish move. So it is more like a falling rectangle kind of a wedge, not completely rectangle, but falling wedge where the funnel keeps on closing the more it falls down. Right, you can see that these lines are not straight, they are falling down and they're covering up, they are becoming more narrow. So we can expect a bullish breakout in a downtrend, and this is called a falling wedge. Now let's move on to the raising wedge. A raising wedge is a bearish pattern, just like how falling wedge, excuse me, just like how the falling wedge is a bullish pattern. Now in the raising wedge, what happens? You have this higher line, you have this lower line. Similarly, the price is going to be in a bullish trend. You have one high touch, you have one more low touch, high touch, low touch. And in the raising wedge, you can expect a bearish breakdown. So over here, we have this trend line break. As soon as the trend line break happens, a lot of negative sentiment, a lot of bearish sentiment gets added on, and the sellers try to push the price lower from there. So this becomes your bearish pattern in the market. Now we have a flag pattern. Flag pattern are obviously awesome because they're very simple to find, again, just like double top and bottom. But these are more prominent. I really love these patterns. Now, how do they work? Now, it's a very simple way of analyzing these. There's one high, there's another high, there is one low, there's another low. So it becomes a triangle pattern, literally a triangle pattern. And wherever the breakout happens, that side the trend continues. If the breakout happens on the higher resistance line, if the resistance breaks, we can expect a bullish trend. So if the support breaks, we can expect the bearish trend to continue from there. So this is a flag pattern where it is forming a symmetrical triangle, and the price gets keep on moving into that narrow field, just like this narrow field. And due to that pressure and no space for the price to move, it gives a breakout on the higher end or on the lower end. Higher end, you can add your buy positions. Lower end, you can add your sell positions. A very good and trustable pattern that I personally use a lot. Now we have an ascending triangle pattern. Now we discussed about triangle, right? There are two different types of triangle patterns. In total, there are three. One is symmetrical triangle, which we took an example for. Second is an ascending triangle where the price keeps on moving in a certain kind of a space. Now, how does the space look is the top level is obviously resistance. We have discussed about it. The lower line will be your support. We have discussed about it in trend lines. This is your resistance level. So the price gets rejected. It came here, rejected, again rejected, 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 and again kind of a rejected zone. And this is your support where the price came to support. It went high, went high, went high, went high. So it is moreover forming like a ascending triangle pattern, the shape basically, because the price keeps on ascending. It keeps on moving higher. And finally, because of that narrow at the end, because of this narrow pressure, the price gives a bullish breakout, and there's a retracement touch, and the price keeps on moving higher from there. But ascending triangle is considered a bullish pattern, but it does not mean it gives you a bullish pattern all the time. If the breakout happens on the support, like the support breaks over here, then we can expect the price to go much lower in the market. So it can break higher also, it can break lower also, but more probability is on the higher end. Now, whatever we discuss about ascending triangle, it is literally the same in descending triangle. In descending triangle, the market keeps on descending. The price keeps on descending where support is your stiff level, whereas on the ascending, resistance was your stiff level. And in support, the resistance is stiff. The support is stiff and the resistance is the trend line. So whenever the price came to your trend line here, rejected. It came again to your trend line here, rejected. Finally, the neckline is your support here. On ascending triangle, the neckline was the resistance over here, right? Over here, the neckline is the support. As soon as the support breaks, you wait for a retracement and the price keeps on falling from there. So again, let me inform you about this, that descending triangle is considered a bearish breakout pattern, but it doesn't mean it will give you a bearish breakout all the time. Most probability is yes. It can also give you a bullish breakout. It can break the resistance level and go higher from there, highly possible. Now, with the symmetrical triangle, that is something that we already discussed in the first example. There's nothing but the symmetrical triangle where the price keeps on getting narrow in that triangle. If the bullish breakout happens, add your buy positions. If the bearish breakout happens, add your sell positions. Now, these are some of the most commonly used trading patterns that you can look for, plus apply it in the live market to get your results in. I hope this episode was filled with new content for you. See you in the next episode.